So hi everyone. My name's Ingrid Kvangraven. I'm chairing this session. So this is a session on challenges of financing of health and social policy. So very relevant in the current pandemic. So parts of this session is being recorded, but it's only the video of the audio and the audio of the panelists. So don't worry if you're an attendee, you're on mute and without video. But to ask a question, you can use the Q&A box. So you'll see that at the bottom bar. So please just ask the questions as the speakers are speaking, and also mention which speaker you're asking the question to. And then at the end of all the speakers, or both of the speakers, will pick out the questions. And you can also look at what other people are asking and upvote the questions that you're also wondering about, and comment on the questions if you want to do that. To those of you who are on Twitter, you can find us at AAG 2020. And if you have any tech support questions, you can put them in the chat. So any tech support questions in the chat box, and then the substantive questions would be in the Q&A box. And Danielle Guiso, my colleague, is here answering the tech questions. So with me today, so we were supposed to have 3 speakers, but actually, it looks like maybe we'll have 2.5. So Paula Guidolin is here, who'll speak on the financing of healthcare in Brazil, underfunding and austerity policies. And then we have Geoff Crocker, who's speaking on basic income and sovereign money, a heterodox economic paradigm, the alternative to economic crisis and austerity policy. And then Robin Latimer had some health complications, but he has recorded his presentation, and we're putting it on the AHE forum, so you can watch it asynchronously and then give comments there. But actually, it looks like he will be joining for a little bit anyway, or we'll be able to make some comments at least. Just chatting with him here. So that's great, actually. But we'll start with Anna. So
thank you, Ingrid.
The floor is yours.
Let me share the screen. Do you see it?
Yep.
Yes.
Okay. First, I'd like to thank all the conference organization staff. I am a member of Political Economy and Conjuncture Studies Center of State University of Campinas, and I'm going to present the financing of healthcare in Brazil, underfunding and austerity policies. First of all, my hypothesis is that austerity policies hinder the guarantee of the right to health, assuming its realization requires adequate and resilient funding towards the business cycle. In other words, healthcare funding needs to achieve proper levels and cannot drastically vary in economic crisis. So the first section builds theoretical connections between human rights and economics and highlights evidence in the literature about the relation between crisis, austerity, and health. In the juridical field, there is a dispute given by these 2 principles over the degree of interference that the sphere of economics could have in guaranteeing human rights. So the first one, the possible reserve, states that rights are subjected to the restriction of resources, thus opening space to the creation of an artificial insufficiency of resources, hiding what actually is a political decision. And on the other hand, we have the principle of the existential minimum that states the need to attend basic needs of society, like health, by a progressive realization of social rights using all the available resources in society. So, existential minimum is more compatible with the dynamic character of the public budget, because, as we know, the government has a degree of freedom to create, capture, and allocate resources, and this should be made in order to guarantee economic and social development. To understand how economic crisis and austerity policies affect health, it is useful to consider the biopsychosocial approach that puts health as a result of the individual's living conditions and thus as a product of the social organization. So, economic crises are recurrent in the capitalism, and there are many ways to deal with it. But the orthodox approach imposes fiscal austerity as the only possible answer. But this shrinks aggregate demand, thus worsening the crisis and putting away the recovery. So there are deterioration of the social situation that can be seen on labor markets and impoverishment. And this scenario brings health consequences related to mental health, risk factors, and demands for public health care. And besides this scheme, there are demographic trends like the population aging that changes its epidemiological profile. So that is a theoretical scheme, but there are some socioeconomic and health-related data that give support to this view. Starting with Brazil socioeconomic data, Brazil is passing through the slower GDP recovery in all its history. 7 years went to waste in terms of economic activity, and surely after the pandemic, it will get worse. We have already had a lot of austerity policies, like Constitutional Amendment 95, that we are going to talk about later, labor reform in 2017, and pension reform in 2019. The labor underutilization more than duplicated between 2014 and 2019, reaching almost 25 million Brazilians. And extreme poverty reaches records year after year, but at the end of 2019, there was almost 14 million people living in miserable conditions. In other words, living with less than $1.90 a day per capita. So it is clear that we have a crisis. The politicians choose to apply austerity policies, and this brought a social deterioration in the labor markets and impoverishment. Now moving to health-related data, the crisis brought a reversal in the trend towards less healthy habits, which includes alcohol abuse and smoking and other like reduced consumption in vegetables and physical activity. And a really interesting paper published at The Lancet shows that there was 30,000 additional deaths associated with increases in unemployment. There is also a decreased movement in the private health insurance coverage, thus increasing demand for public services, for SUS services. And the percentage of elderly people in the population will almost duplicate in 20 years, changing its epidemiological profile and also increasing demand for SOS services. So we can see that crisis brought consequences.
Seems like we lost Anna. Let's give her a couple of seconds to see if she can come back.
SUS creation and funding. I'm not going to bother you with many details. I try to give just a brief overview. First of all, before SUS, there was a segmented and excluding healthcare system. Only formal workers and rich people had its right to health guaranteed, but the majority of the population depended just on charities. But there was a huge social movement which resulted in the creation of SUS in the Constitution of 1988. However, it was missing a definition of the mechanism responsible for SUS funding. In the 90s, there were temporary solutions that did not represent an increase in stability for SUS funding. And it is worth to say the scenario of neoliberal rise was hostile to the constitution of universalist social policy. And this antagonism gave rise to the chronic underfunding of the health system. With the Constitutional Amendment 29 of 2000, it was established a new category for SUS funding, that is Public Health Actions and Services, or ASPS in Portuguese, which defines the core expenses of public health care. So from now on, if I said ASPS, please understand it like SUS funding. But it received critics because there was fiscal space to fraud. It was not properly defined which budget categories were ASPS. And while states and municipalities had a definition of a minimum percentage of their revenues that should be applied on ASPS, the federal government received a temporary definition that ASPS expenditure would be adjusted only by GDP variation. And a definitive policy to federal SUS funding would be defined by a complementary law. And only 12 years later, it was enacted the expected complementary law 141. And despite the clear definition now of which budget categories would be considered as ASPS, thus reducing space to fraud, it was a late and insufficient regulation because it did not define a different funding policy to the federal government. 3 years later was enacted Constitutional Amendment 86 that represented a budgetary setback as it defined the ASPS federal expenditure on a revenue percentage that represented a contraction in the health budget. And talking about these constitutional amendments, there is a process to turn it unconstitutional on Supreme Court, but it has not received final judgment yet. And finally, the current rule, and which represents austerity itself, after the impeachment of President Dilma Rousseff, her vice, Michel Temer, proposed the Constitutional Amendment 95. And according to this rule, primary expenditure is adjusted only by accumulated inflation. And this is valid for 20 years. In practice, under the expenditure ceiling, as it is known here, there will be a reduction in public spending in relation to GDP and the number of inhabitants per capita. This measure, now talking directly about health, this measure froze in real terms for 20 years the ASPS federal expenditure. Thus, it represents permanent defunding for SUS. The third section brings some considerations about ASPS expenditure cycle and some plots showing its evolution. So after the value is authorized by an annual budget law, it is followed by commitment, certification, and payment. We can say that commitment is like a promise, and only the payment stage equals to the service offer. So what is the issue? Minimum level of ASPS federal expenditure does not measure real service offer. And this happens because this minimum level is verified based on commitment stage, and there are unpaid commitments that can be both cancelled or postponed year after year. And based on this issue, we consider that the payment stage is the most appropriate for the concreteness and for the ease of its monitoring. Here on the left, we have the total committed compared to ASPS current minimum, showing that usually the amount committed is equal to the minimum level. In other words, what should be the minimum expend turns out to be the maximum committed. And on the right, we have the total paid compared to the ASPS current minimum, showing that usually the amount paid is lower than the minimum level. And this is very strange, but this happens because of those unpaid commitments. So, analyzing only the evolution of ASPS total paid amount in real terms, it is clear that the annual real growth rate has been dropping, moving away from the 6% trend represented by the dashed line. And this deceleration represented an accumulated real loss of almost 50 billion reais in relation to the previous trend. And finally, these are the paper final considerations. First, we cannot stay attached to mainstream economics, which claims a false scarcity of resources and hinders the fulfillment of social rights like health. It is necessary a radical transformation of macroeconomics paradigms. And second, we saw that SUS underfunding turned into a defunding, compromising its responsiveness to crisis consequences and, of course, to the pandemic. And it is time to question the validity of tying social rights resources entirely to the economic activity by GDP growth or a revenue percentage, mainly because it is precisely on crisis that the demand for social rights like health increases. And this leads us to the last one, the need of counter-cyclical and protective policy in a crisis conjuncture. To Brazil, it was a need already before the pandemic, but now it gets an emergency character. Thank you all. I'll be happy to answer some questions.
Perfect. Thank you so much. Okay, so I encourage the attendees to start putting their questions in the Q&A box. But while you do that, I want to give the floor to Geoff Crocker, who will be presenting on basic income, which is also it's also a policy that has been getting more attention now in the wake of COVID. So yeah, I'll give the floor to you, Geoff. You're on mute.
So you can hear me now, yes? Can you?
Yes.
Okay, so I'll go back to the, hope this is the right presentation. Share. Yep. So can you see the slide now as well?
Yep, perfect.
You can hear me and see the slide, yeah?
Yep.
Okay, thanks a lot. Well, thank you again for this invitation to present to the conference. With some apologies to anybody who's at the Open University, because it is rather a repeat of that presentation with a few updates. But so I'm going to be talking about a thesis that leads us to a new heterodox theory of income and a new heterodox theory of money, which is much in vogue and discussed a lot at the moment. So relevant to Anna's presentation, where she was talking about austerity policy cutting health requirements in Brazil, I'm going to be talking about the way in which basic income and sovereign money are a system corrective both to economic crisis and to austerity policy. And the links at the bottom of the first screen there, you'll see I edit a website called The Case for Basic Income, which is www.ubi.org. And also, I'm the author of a recent book on basic income and sovereign money, which I was very glad to see was positively reviewed in the Financial Times recently. So it is gaining attention. We have a research project at the University of Bath, the Institute of Policy Research there, led by Nick Pierce, with Ida, who's actually a Mexican economist, working as the main postdoc person on it. She was at York before, actually, Ingrid, so she came down to us from the York Economics Department. And I helped initiate a basic income conversation, which is based at Campus, the left of centre think tank in London, led by Neil Lawson. So, I just pressed page down and nothing happened. Oh well, two. So with apologies for the automation goes wrong, Ingrid did warn me. This is the hypothesis in outline that I'd like to work through. It is that automation in high-tech economies generates a structural need for unearned income. So I shall argue and I shall present data which empirically demonstrates, in my view, that technology has reduced the wage share, the earned income share of consumer expenditure and of GDP, and that there is a notable trend for unearned income in the structure of the economy. And incidentally, it did say on the title page, this is a work in progress. So, I mean, please feel free to critique it heavily, because I'm very interested to refine it and to deal with any inadequacies in it. So questions and answers are fine, but I'd be very happy for you to make contrary comments and suggestions and so on. So please do feel free to help me refine it. So unearned income is increasing in the economy. And I'm using UK economy data because that's the only data that I have good access to. It's quite difficult, as many as you will know, to access your national economic data, even in your own language. So I've had to have help from ONS to understand it. And I'd be very keen to see if we can compare this data, the findings I present from the UK economy, to see whether they are typified by other economies, other national economies' data. So the unearned income comes as pensions and dividends, which I argue are sustained. This is certainly the case in the UK, because pensions have been upheld, certainly private pensions and even public pensions, and dividends have grown. Whereas the other area, areas of unearned income are welfare benefits and household debt. Now, welfare benefits have been hit by austerity, and household debt has been climbing to unsustainable levels, which has increased inequality and therefore produced crisis. So that's the main idea behind what I have to say. Financial orthodoxy, of course, requires that money is backed by interest-bearing government bonds, that government budgets have to balance, a deficit has to be reduced, and hence austerity is applied. I will argue that this is very much the tail wagging the dog, that we're taking the artifact of money and using it to control the real thing of humanity and its economy, and that we need to redefine that relationship into a heterodox view. So basic income, I'll argue, is the necessary and best form of unearned income, and I'll say why, in my view. Basic income is superior to pensions, dividends, welfare benefits, and easily, of course, household debt as a way to provide the income necessary in the economy. And that sovereign money funds consumer and government spend. Of course, it creates no debt, it imposes no financing cost, and it avoids inflation by observing the output GDP constraint. I'll argue that's the case I wish to argue, and I will also argue that there are currently inferior surrogates for these things in the actual economy, i.e. that household debt is an inferior surrogate to basic income, and that government deficit is an inferior surrogate to sovereign money, and in fact causing the system to collapse. This will be familiar that the current economic system is pretty dysfunctional, and any heterodox economists and probably most orthodox economists will agree too, that the system hits crisis actually 10 years ago and in repeat again on more than 10 years ago. And that debt is pervasive both at household level and at government level, that we have continuous austerity policies applied, extensive policy, low paid jobs, poverty in work, so a job isn't guaranteeing adequacy of income, and ecological damage. So all of those things suggest we need to rethink the system and look at significant and radical system re-engineering. Now, the explanation for the crisis was typically the bad guy theory, that bad banks created excess debt and bad governments failed to regulate substantially. It's an interesting mantra, of course, and the press love it because it gives somebody to blame. And the correction that came from that analytic was to get the debt down by tighter bank regulation, by quantitative easing, and by austerity policy. But I would argue, since this isn't working, is the hypothesis reasonable? Is it realistic to say that the debt explosion was caused by bad behavior, i.e., is it reasonable that in all countries at the same time all banks misbehaved, and that in all countries at all times governments mismanaged? I suggest that that's actually not a very credible hypothesis, and that a much better hypothesis is that there is something structural going on in the economy which is leading to this pretty common experience. What caused this debt explosion? Was US prime debt for housing or consumption, and is the crisis structural rather than behavioral? And that will be my argument, that the crisis was structural, and that it is those structural issues which lead us to a systems redesign. This is, I won't go through this in detail, but this is an attempt to show a time series from 1948 onwards, where UK economy, of course, where I track data showing that earned income becomes increasingly insufficient to purchase output GDP, and that unearned income increases to compensate. And we went through a period first of Keynesian fiscal demand management, and then from 1973 roughly onwards, went into monetarism, where we tried to run the economy by controlling the quantity of money, realized that we couldn't do, because particularly credit cards and so on, people could create their own plastic money, and therefore monetarism too tried to control the economy through the price of money, i.e. the interest rate, to control inflation. This led to 2004, again UK data, when household loans peaked at 165 billion. That's new household loans in that year, leading to default because those loans proved unrepayable. So we had the crisis in 2007, and from then on, household loans fell in 2008 to 4 billion, but because of those three policy variables there in the right, highlighted in yellow, tighter bank regulations, austerity, and quantitative easing, we saw these effects, that welfare benefits fell because of austerity, that asset prices increased because of quantitative easing, increasing inequality. And by 2017, and I need to update this data really, but household loans have increased back to 77 billion, inequality is increasing, poverty is increasing, and we may well be expecting the next crisis. This is a fundamental slide, and this is showing consumer expenditure against UK labour income from 1948 to 2016. And you can see there that there is a inexorable, very slow, but inexorable long-term change for earned income, the labour income, to decrease as a proportion of consumer expenditure. So what we earn by work is less able to meet what we need to consume. And the turning point was in 1995. So 1948 to 1995, labour income exceeded consumer expenditure, but after 1995, consumer expenditure has increasingly exceeded labour income defined to be wages plus self-employed incomes. And I do thank the people at the ONS who've helped me get this data correct. So I'm reasonably confident that is reliable data. And the thesis is that this is due to technology that has caused output growth in excess of wage growth. And that is the subject of the research project at the University of Bath, to test the hypothesis that a technology variable is responsible for this change in structure, so that wages, real wages, are flatlined in the USA, for example, for a long time, and that you get in work poverty because wage is insufficient to buy the outcome. So that's the hypothesis in a high-tech economy, as macroeconomy needs unearned income. What are the causes of debt? Now, a number of commentators like Adair Turner, Martin Wolf, and so on, point to the issue of debt. But if we try to dig more deeply, what is the cause of this debt? Well, this tracks UK GDP, disposable income, and household loans. And the claim I make, first of all, in this graph is that between roughly 2000 and 2007, you can see that GDP increases at a much higher rate than consumer expenditure, and that the gap is made up by the bottom line, which is household loans increasing substantially. So over that 6-year period, disposable income flatlines and grows by only 16.1%, whilst GDP grows by 24.8%. Of course, this could be due to other causes, such as a high growth in investment, government expenditure on net exports. But it's clear from that diagram I suggest that some of the gap is met by the 52.1% growth in total, that's total new household loans per year, which is unsustainable, therefore leads to default crisis and austerity. Meeting the gap with basic income rather than with household loans, I claim, would avoid both crisis and austerity. Now, in this one, I tried to take the last diagram, and the top line shows the gap. This is the gap between GDP and disposable income. And that gap is very clearly growing. And on the bottom line is household loans replicated. And I claim this is a very simple claim based on a visual observation, but the visual observation suggests that the household loans roughly follow the same curve profile as the gap between GDP and disposable income, i.e., that gap is being made up by increasing household loans. And the point I'll make later is that these loans are largely to low-income households and are being charged a very high payday lender rates and increasing equality. So the curves follow the same profile. And the household loans peaked at 165 billion. Underconsumption and debt. So the claim, therefore, is that the crisis was structural and not behavioral. And I know it's nice to do all this bank bashing and government bashing, but I'm claiming there's a structural cause to the crisis, because the remedial policies of financial regulation and cost QE and austerity have proved ineffective, and the crisis can repeat. If we compare the 1930s crisis, of course, Keynes was already arguing that low wages reduce aggregate demand and they cause rather than resolve crisis. So his argument with the neoclassicists that they wanted to reduce wages to, quote, price people back into employment. And he pointed out you just see a reduction in aggregate demand, and which needed higher wages. And also lower interest rates and increased money supply were ineffective due to his theory of liquidity preference. And James Devine in the 1994 article provides very interesting analysis showing that stagnant US wages led to increased household debt, which is in line with the thesis that I'm trying to develop. The 2007 crisis, Skidelsky, Turner and Wolf, showing that pervasive debt is the cause, And a lot of the household debt was actually for consumption. Sometimes it's secured against housing, but that's only as a security rather than to buy a house. So is this due to technology, which I'm claiming, is it due to globalization partly, or is it due to worker power? This is a very familiar graph of deficit. And this is the UK deficit as a percentage of GDP up to 2017. And a very simple observation is that it's pretty pervasive. There's only 2 years there when there is no deficit in the system. So I'm arguing that deficits resulting from a lack of sovereign money in the system, i.e. is a surrogate for the sovereign money which should be there, and I'll define sovereign money later on. Financial orthodoxy reduces the deficit by imposing austerity, which can be avoided if sovereign money funds the system. So again, this is UK debt as a percentage of GDP. Hang on a sec. So the points I'm making, let me go back. I'm going to go back as well. The point I'm making here is that this debt is, of course, non-repayable. I mean, the idea that we're going to take 85% of GDP, or post the pandemic, 100% of GDP, or in Japan, 234% of GDP and pay it back, it's just a complete myth. And everybody knows this is a complete myth, yet we go around like emperor's clothes, you know, pretending that somehow this is a burden upon our grandchildren. They're going to repay 2.34 times the annual GDP. It's about time we got real and admitted that's never going to happen. Compared to deficit spending, sovereign money would be debt-free, and it's notable that in the UK, the servicing charge of the debt is 39 billion a year, even at low interest rates. And financial orthodoxy is imposing this false policy choice between a deficit and austerity, which sovereign money releases us from that false choice. So here are some deficits for the G7 economies. You see a similar picture there, of course, that deficit is pervasive because it's a surrogate for the sovereign money which should be there. And that's showing the ever-increasing debt, as I say, Japan on the right-hand side there at 234% of its GDP as its debt. So it's a myth that it's ever going to be repaid. So I work towards a new policy paradigm, and two kind of thoughts towards that are, imagine that we could replace household debt with basic income. So if I could have taken 164 billion of household debt in 2004 in the UK and simply replaced it with basic income, then I assume we would have got a similar macroeconomic outcome, you know, because the same people would have had the same money, except we wouldn't have had the debt in the system. We wouldn't have had the household debt in the system. And if it had been funded by sovereign money, we wouldn't have had the government debt in the system either. Now, I'm not saying this is what we should do. I'm trying to use this as a sort of slight thought exercise to say that basic income is a superior method of unearned income, and also replacing government deficit with sovereign money. So I'm working towards that. Now, stepping back to the argument from technology, the second machine age, which you'll be familiar with, Brynjolfsson and McAfee, that it's automation will lead to unemployment, social exclusion, low economic demand, recession, unsustainable consumer credit, and so on, and austerity policy. Basic income will break this vicious circle. Question is how to fund it. The answer I'm proposing is sovereign money. Here is another thought experiment, that if we were able to plug a machine into the earth in a totally automated economy, so a machine plugs into the earth, produces all the goods and services we need, in that scenario, 100% of the GDP would be basic income, because the only way of distributing the goods and services would be to give everybody vouchers. So you give them all vouchers, they hand them in, they're destroyed, and they're issued again the next year. In that scenario, 100% of GDP is basic income, and 100% of GDP is sovereign money, which is debt-free like coinage. Now, of course, this is only a thought experiment, but the nuanced argument from that is that in high-tech economies, that unearned or basic income becomes an essential component of demand, and equally that financial deficit is inevitable, or it's a surrogate for what should be there, which is debt-free sovereign money. So we need a heterodox economics view, which is that consumption, investment, consumer income, and UBI are rendered affordable by output GDP and not public sector financial balances, which are only an intermediate variable. that money has no inherent value but derives its value from output GDP. So the idea that money was backed by gold, or the output, or that money is currently backed up by the sale of government bonds, both are heresies. Both are orthodoxies which heterodoxy should challenge, and say money only derives its value from the goods and services to which it refers, and that a sovereign state can create sovereign money solely against output GDP potential, not gold reserves or sale of government bonds, and it could do it without creating debt. So it's stating the same thing, really. Financial orthodoxy sees money as having inherent value derived from either gold or the sale of government bonds, that money is real, can't be created or destroyed, that government budgets must balance, and that affordability is defined by the government's financial reserves, whereas a heterodox view is that money has no inherent value but derives its value from output GDP, that a sovereign state can issue money versus GDP without creating debt, the financial deficit or sovereign money is inevitable and manageable in economies, and that affordability is defined by real resources and productive potential. So to take Anna's comments about healthcare in Brazil, it's clearly ridiculous to say you can't afford healthcare when you've got so many million people unemployed, when you have the real resources. And to say that the financial balance in the treasury means that you can't provide that healthcare when you've got the people there to do it is a pretty obvious nonsense, really. And I just show that diagrammatically, that on the monetarist theory of money, you've got gold reserves or the sale of government bonds giving value to money, which then goes into investment, production, wages, and produces tax back in the circuit, or in this radical neo-Keynesian heterodox view that investment and production create output GDP, which gives money its value. So monetary theory of money predefines money value and applies this affordability test, whereas the neo-Keynesian theory of sovereign money ascribes money value from output GDP. In high-tech economies, therefore, the hypothesis unearned income is an essential component of macroeconomic demand, and basic income is the best form of that, and financial deficit or debt-free sovereign money creation is necessary. Here are very quickly other great reasons for basic income: human flourishing, i.e. We have more choices and options in life than going to the factory or to the office for 5 hours every day, whatever it is. Ecological responsibility. Basic income breaks the link between employment and income. Therefore, the only way to income at the moment is employment or benefits, but even the benefits are trying to drive people to work. And that's producing more consumption, more pollution, and so on. Social justice is another great reason for basic income. I refer to Guy Standing's work in the precariat. And administrative welfare efficiency, i.e. if you're going to have any benefit system at all, basic income is the most effective and the least costly. These arguments often fielded against basic income of work disincentive. You know, people won't want to work, whereas in fact, it's the present benefit system that's a work disincentive, because if you take a job, you lose your benefit in the current system. And affordability is the usual other big objection to basic income, when I'm arguing that it's GDP, not government funds, which determine that affordability. So Stephanie Kelton's recently written on, in her deficit myth on sovereign money. Here are some other great reasons which Joseph Huber's also written about: returning seigniorage of money to the state rather than to the financial sector, giving the state control of the money, and reducing reliance on the interest rate as the sole mechanism. Here's an attempt to show, I won't go through this diagram in detail, but it's there on the website if you'd like to look at it, to show in the dashed lines how sovereign money would replace QE as a way of funding the economy, how money is created and flows. So there's a question as to how you define sovereign money, and there are three basic definitions that I've found. One is the modern monetary theory school, which sees sovereign money as funding jobs guarantee, which sees money creation matched by debt creation. And that's where I would still disagree with the MMT school on the second point. But says that the debt so created is balanced by surplus in other financial sectors. This is the Wynne-Godley identity. And then they would apply a zero interest rate to funds parked overnight. That's roughly Randall Wray, Stephanie Kelton, and the MMT school. The bank money definition of Joseph Huber, Joseph is keen to avoid banks lending too much money, therefore he wants the state to take over that role. Whereas my basic income definition is that sovereign money funds aggregate demand to full potential output GDP. Money creation is not matched by debt creation, and this avoids excessive consumer and public sector debt. So those are those three views of sovereign money summarized in a table there, one from Stephanie, one from Joseph, and my own there. So, evaluating UK anti-crisis policy, bank regulation tightened conditionality. It became more difficult to get a loan. Loan values were reduced against assets and so on, and against income, but new household debt has still grown substantially. QE, the bank lending was constrained, not enabled, and the Bank of England said that GDP went up by about 1.5%, but asset prices certainly went up deliberately, and therefore inequality increased. And on austerity, I refer to Porter's and Reed's work showing welfare cuts hitting low-income families and 1.5 million increase in child poverty, and Philip Alston's UN report quoting 40 million people in poverty and 1.5 million destitute. So, and this is my final slide, I'm working towards a system where basic income and sovereign money become the corrective for economic crisis and austerity policy. So output GDP defines debt-free sovereign money. What money we can issue is defined by what we can produce. That goes into government expenditure, like health, like other welfare benefits, and it goes into basic income for consumer expenditure. And the claim is that that would produce no austerity, no crisis, would reduce poverty, reduce inequality, increase the ecological outcome, and increase the human outcome. And very finally, and shamelessly referring to my own book, on the basis that I have a zero royalty contract with Palgrave Macmillan, so I don't benefit from this other than by increasing the debate. So the book's available now, has been well reviewed in the Financial Times. It's actually been submitted for the FT and McKinsey 2020 Best Business Book of the Year. It's not yet been decided that it's on the long list, but it's been submitted. So, and the arguments are summarized and amplified in that book. So thank you for your attention, and I'd be very happy to discuss any of those issues. Stop sharing.
Thank you so much. Great. So as Danielle dropped in the chat, the third presentation will be on the forum asynchronously. So we have a bit more time for questions, or alternatively, we might end early since we only have two presenters. But yeah, please put your questions in the Q&A box. I did receive questions by chat already, and I have some questions as well that I'll start asking while other attendees think about their questions. So one for Anna. So you said that what's needed is this radical transformation of macroeconomic paradigm necessary to promote human rights, which I think, I would agree with. But I wonder if you could expand a little bit on that. Like, what do you mean? What kind of transformation would actually be necessary in the case of Brazil? And that also would allow you to bring in some of your, I don't know, theoretical background or something that that you have in the back of your mind while you're working on this paper. It would be interesting to hear. And also, I guess a similar thing to Geoff, and Robin also asked that in the chat about your theoretical framework. And I think you actually clarified it a little bit later on in the presentation, but it was interesting because first I was wondering, oh, is this a Keynesian approach? And then I thought maybe it was MMT, but then it turns out you actually have your own basic income theory of sovereign money. So maybe it would be interesting to hear a bit about what role theory plays in your project. And then I got another one for you from the chat, which was, instead of adopting basic income, wouldn't it be more effective to promote structural reform of the labor market? And another one from the chat for Anna as well. What's your view of Bolsonaro's treatment of the health system in the face of COVID-19? So maybe Anna wants to go first since you're the first presenter.
Okay. So starting with what am I talking about when I say radical transformation of macroeconomics paradigm? Well, I will repeat myself. So budget is dynamic, and this degree of freedom to create, allocate, and capture resources gives much liberty to politicians. So I think Geoff already gave much ideas about how to create resources and also use the available resources, because as he said, we have a lot of people employed, and also the utilization capacity is very low because of the crisis. So we do have resources, and also alternatives to capture them, because in Brazil we have we need a reform in our tax regime, but because it is now very regressive. It's based only on consumption, in majority on consumption. So we do need a tax reform, but nowadays we are discussing, and the Congress is discussing a tax reform that is very narrow. It is not good enough and will not result in more resources. So, and also alternatives to allocate them, because in the recent years, there was in the budget an increase in defense expense, and this probably has something to do with the military origin of Bolsonaro. So we are spending more on defense and less on health and education. So it is a choice. I think this is the, if I could resume all of it, we need to see the budget as a choice, a political choice, and not a economic technical thing that is static. No, it is dynamic. And now talking about Bolsonaro response to the pandemic. Well, it is, if I could say in one word, irresponsible, because since the beginning, he was like another president, like Trump and like Boris Johnson, was also like mistreating, like it was a little flu, it was not so a big problem. But Bolsonaro, I think nowadays is the president, is the national leader that doesn't give a minimum importance to what is happening. And the measures we included, I would like to say that we have an emergency basic income related to the pandemic, but it was a late measure, because we have already like 1 month of pandemic when it was enacted, and a lot of people already had lost their jobs, or well, we have a lot of informal workers too that were suffering. And the measures towards firms was also insufficient, because it is very difficult to get credit for governments. So a lot of firms are bankrupting, and this loss of income and this general bankrupting is, of course, it is a consequence of the pandemic, but not only, it is also a consequence of this irresponsibility of Bolsonaro. And this will make it more difficult to recovery.
Thank you. Geoff?
Yeah, in terms of theory, yes. I mean, I'm basically an unreconstructed Keynesian. I think that his fingering of aggregate demand as the main variable that needed management was correct and remains correct. So I think that in that sense, my diagnostic is neo-Keynesian. In terms of MMT, as you say, I tried to expand that a bit. I agree with the MMT school in that money, on the theory of money, that money can be issued by a sovereign state. But where I don't agree with them is that it should be matched by debt. And I think in following that particular route, and Stephanie Kelton follows that route as well, but following that route, A, you impose a financing cost, which is substantial, and which goes back into the financial sector, incidentally. And B, you then rely upon this Wynne-Godley identity to show that other financial surpluses in the rest of the economy, in the overseas economy and in the personal sector of the economy, balance out the government deficit, because by definition, if you have a closed financial system, then balances must add up to zero. My critique of that is that I think they tend to use that as a behavioral equation rather than as a post hoc identity. So probably don't have time to go into that in detail here, but that's my challenge back. That I think the identity is being incorrectly used as an equation. Now, I was saying that you can avoid all of that by just saying you can issue money without debt, which we do coinage anyway. Coinage is issued without debt at the moment, but it's only 3% of the money issued. But talking about COVID, in the UK's response is going to be a package of about £645 billion put into the UK economy, which they're going to do on the gilt market. And I just don't understand, what is the reason to define the 645 billion as debt with an interest cost against it into perpetuity, and it's never going to be repayable, compared to just issuing it. If you put the same money in the same place, but you don't assume any debt against it, seems to me that's perfectly doable, but it's too scary for people because it doesn't follow orthodoxy, which has double entry accounting at the core of money issue. So yes, I'm Keynesian, and yeah, I'm partially MMT, but I don't follow them down the debt route. And the other route I don't follow them down is on job creation, on job guarantee. And it's not because I'm an anti-job or anti-work or anything. It's because my fear is that job and wage are no longer the levers to rely on for income that they used to be. And I think that technology is reducing the relevance of wage and job as a source of reliance for people's income. So that's. And job guarantee to me has all sorts of other difficulties. How do you define it? What sort of job do you offer somebody who's lost their job? If they're before a lawyer, do they get offered a job as a lawyer within 5 miles of where they worked before? And when employment picks up in the economy again, the MMT school says that these jobs will be rescinded. So people will be switching around back into almost a gig economy developed by the job guarantee scheme. So I think administering it becomes like a workfare. You get your benefits and your income support if you'll take a job that's offered you by the state. That feels pretty liberal to me. So I'm not comfortable with the job guarantee scheme, although I'm not, of course, not against employment if people want it. But that comes around to the second question as to, is a change in the structure of the labour market a preferable solution to UBI? And my view on that would be, well, if full employment at high levels of wage were possible, then that's perfectly fine. My worry is that actually technologically it's becoming less and less possible. I sometimes refer to, I used to work as an industry consultant. I went into a Fiat motor factory down in the south of Italy in Termoli, and they were producing 2,300 engine blocks a day. And there were 2 people in the plant. So, you see this level of output with decreasing levels of labor input. And that does match the empirical observations that real wages have been flatlining. Now, we can either say this is because of exploitative capitalism, and weakening of labour bargaining power, which have certainly been there. But if we were then to assume, right, let's maximize labour bargaining power, my worry would be that the very maximum amount of labour bargaining power possible would not overcome the technological shift towards less employment needed per unit of output. And I think facing what I think is the reality of that means that people need secure income from sources other than work and job and wage. So that's why I think restructuring the labour market, which one can see within the labour market, this huge bifurcation, of course, that we're all familiar with, you know, that you're getting very, very highly paid chief executives and very highly paid competent professional people, whereas working wages are so low that there is poverty in work. So can you restructure that? Partly, of course, yes, you may be able to reshare the amount of labour, but in a macro sense, I think not, because I think work is declining. You can look at the hours worked per week over the last 100 years. You know, we were working 100 hours a week, 70 hours a week, now 35 hours a week, and the graph just goes down. So, you know, a lifestyle where we have adequate income and maybe have the ability to work less and do or less controlled work, you know, less factory and office type work, and more creative things that we wish to do ourselves, and can, whether it's care work or whether it's being an artist or whatever it may be, that allows us to flourish and have an adequacy of income, then I would say, why not?
Great, thank you. So while you were speaking, we got one more question from Robin Latimer, and he also says that he presents a different approach to similar issues. So just to the audience, to make sure you check out his presentation on the forum. And he also has a question for Geoff. Do you have any comments on the way that debt can often become money, as suggested by David Graeber and Steve Keen?
Yeah, I need to expand that a bit, because I don't know what particular view of Graeber or Steve he's referring to.
Robin, do you want to expand a bit? Are you here?
But if not, I mean, all I will say is that you know, my sort of proposition is at the moment in the status of a hypothesis and a work in progress. So I don't claim to be able to necessarily answer all questions, but I'm very open to other contributions or ideas. But debt creating money. Well, of course, debt does create money. As Joseph Huber's book on sovereign money shows, it's fairly clear. You know, commercial banks create money by creating debt. Maybe that's what Robin's driving at. But the thing that I differ slightly with Joseph about, whom I know, you know, he and I had dinner together in Berlin recently. So he is that he would stop all commercial banks being able to advance any money. Now, the reason that the sovereign money vote was lost in Switzerland was partly because the Bank of Switzerland was against it. And they said, well, we haven't got the competence to take over all these commercial bank money lending. And I have some sympathy with that. I think, you know, if it's not broke, why fix it? So if the commercial banks, when they're lending to regular industries, you know, to build a factory to produce some pharmaceuticals or whatever else it may be, if that's working okay and they've got the competence to assess whether the project is credible or not, why not let them get on with it? Why nationalize something that seems to work reasonably well? But what I'm against is the idea that the government itself can't create this money. Not that it should therefore necessarily create all of the money in the economy, but it should have the right, it does have the right to create sovereign money that's debt-free. So yeah, commercial lending by banks, debt does create money. Joseph was perfectly correct about that. I personally don't want to stop them doing that, as Joseph does. I want, and that's where he does agree with me, we both want, and I think MMT schoolers want as well, the state to be able to do it. But in my case, I want it to be debt-free. I don't want the state to pick up a debt.
Great, thank you. Okay, so I think we'll finish here because there are no more questions. And I guess it's pretty much on time given that we don't have the third speaker with us. So what we will do now, because we have the award ceremony following the session. So I'd first just like to say thank you so much to Anna and Geoff for your amazing presentations. And then, so now I'm going to demote you to attendees.